All right, we'll jump into it. We are live on Facebook, and thanks for joining us. Nora, I'll have you kind of start us off.
Okay, hi everyone. Happy August. Before we kind of dive into it, one thing I did want to talk about today is some updates and changes to the CARES Act and the American Rescue Plan. So some of you may have already received some of the direct deposits starting July 15th for the child tax credit. So a few updates here for qualifying individuals. If you have a child under 6, that went from $2,000 to $3,600. And if you have a child under 17, that went from $2,000 to $3,000. So you should have already received some of those direct deposits into your account, depending on how you filed your 2019 and 2020 taxes. Qualifying individuals, this includes anyone, if you're married, filing jointly, if you made under $150,000, and then if you're single, filing head of household, that's anything under $112,500. So a few updates there in terms of the child tax credit for 2021. There's also some updates into the eviction moratorium and the unemployment benefits. So one thing we would encourage you is to use the Department of Treasury website as a resource for any updates, for direction on following up or finding more information or how to file some of these, especially with the child tax credit, some updates there. So as always, use Sean and I as a reference and a resource, but would encourage you to visit the U.S. Department of Treasury website for more information on those updates to the CARES Act and the American Recovery Plan, Rescue Plan.
Yeah, and all this stuff is really confusing. And so, for example, the advanced child tax credit, it's using previous tax returns to do the calculation, which means if you've had a pay raise, you could end up owing that money back. So it's good. You're able to go on Treasury website and actually stop those payments from coming. The money would still be due to you like it normally would be on April 15th. So you're not actually getting any more money other than the slight increases. You're just getting that money in advance, which means if you get that money in advance and you got a pay raise, you're no longer due that money, then you'd have a higher tax bill. So this is probably where accountants are going to get mad, because on April 15th, you're going to blame your accountant for not having as big of a refund. And that may be because you had partial payments for your child tax credit paid in advance. So this isn't necessarily an increase in what you'll see, but you could kind of run into some confusion on April 15th when you go to file your tax return if you don't have as big of a refund as you're normally used to, or what have you. So just know kind of how that plan is structured. It is a little bit unique. And then the eviction moratorium is something that we're watching in the markets. Evictions are starting to take place for most renters. And so we may see things like foreclosures, more like things like that happen on the market as all that money is due. And so it'll be interesting to see kind of how all this stuff plays out, because coronavirus is kind of the hot topic this month.
Yeah, so Sean, kind of playing off of that, with coronavirus, the media, I know we say try not to hone in too much on the media. There's so much noise, but it's hard to ignore the Delta variant going around. Sean, talk to us how that may impact the markets. How are our portfolios performing? Changes that we've made since the first kind of coronavirus. Talk to us about that.
Yeah, so it's what we watch the most right now in the market. And, there is just a lot more fear out there with the media. And we can go into a good discussion by a fire pit about all of that. But ultimately, right, where it impacts portfolios is, do we get into businesses shutting down again? Are we worried about things like that happening, government restrictions? Because all of those things we saw last February, March timeframe had a huge impact on the market. And I'll kind of pull up a slide here very soon, but huge impact on the market. And so that's what we're watching kind of moving forward, is how does the Delta variant, Lambda variant, whatever variants out there, how does that impact businesses moving forward? Do we get into lockdowns? Do we start to take more steps like that? Now, the one thing I would say is we know a little bit more, right? The reason that the first coronavirus recession was so quick and so sharp is because we just had never gone through something like that before. Now we kind of have the data about what that looks like. So I wouldn't expect as sharp of a decline. And what we did see is it came back really, really fast. The markets came roaring back within a year. The year of 2020, even though it started with a negative 34% drop, ended up plus 15%. And so when we see numbers like that, people would say, you know what, we've kind of been through this before, the market's going to come back, I'll stay invested. We won't see as many people run to cash. More than likely, right? That'd be a prediction. I don't try to get into that. And we wouldn't try and time the market either. But I will pull up my slide to kind of show you kind of what's going on in the portfolio. So are you seeing my screen here? Awesome. So the green line here, this is government treasuries. And this is from the date of February 19th to about March 22nd. That was really like the height of all the worry with the coronavirus recession. This is where markets came crashing down within a month. And so we can see this blue line is the S&P 500. Okay, the Fortune 500 companies of America gives a really good idea of what the overall U.S. market is doing. Well, in that month, the market lost over 34%. Right, that was really hard to stomach. People saw their 401ks wiped out by almost 30% if they're in all equities. So we want to have broad diversification in the portfolio. And one of the things that we've learned looking back at some of these things is if you have government treasuries, they were actually positive almost 4% during that same time period. So even though the US market is dropping over 30%, we see that you can actually have what we call an uncorrelated asset increasing in that same time period. And so for people that don't want to take a lot of risk, we add assets like this into the portfolio so that you can be prepared for another recession. If it comes down, you don't want to be selling all your stocks and running this late. You want to be there right now. And so that helps you stay invested throughout any coronavirus recession that may come if we do see a sharp pullback. But for our clients, we want to make sure that we put them in a portfolio that matches their comfort for risk, add in these uncorrelated assets that they can stay invested. And you can see by doing so, you can trust the process. And so that's one of the things that we learned, right, is, hey, we go back and look at these things. Treasuries have done really well in the 2008 time period, the 2001 time period, the 2020 time period when we saw big recessions. And the reason is because people get scared, they sell their cash or they sell their stocks and they run to something safe. So they run to the government treasuries. So treasuries since then haven't done great. And that's because people started selling those and going back to equities, back to stocks, because stocks have been doing really, really well. So again, adding all that diversification kind of smooths out that roller coaster for you so that you can stay invested. And so now is a good time to make sure that your portfolio is diversified. If you're in all the S&P 500 and you don't realize how much risk you take on, it's a great time to kind of reevaluate your portfolio. Make sure you have that diversification in there so that you don't see a big of a pullback if we do go through another recession. So the biggest thing that we're watching is all of this news, all this media coming out, scare tactics, shutting down the economy, masks, you name it. We want to make sure that you're kind of staying informed and know that, hey, your portfolio is built through this. We went through it in 2020. All the portfolios are positive in 2020, 2021. And so if you have that diversification, if you're in a portfolio that matches your comfort for risk, you'll stay invested. And that's what's most important for you. So again, we're watching the coronavirus news very closely, but not making any drastic changes, not trying to time the market, not trying to guess what's going to happen in the future, because we learned back in 2020 and 2008 that no one can do that, right? No one knew the coronavirus was coming, and they won't know if it's coming again. I think you're muted, Nora.
Appreciate it, Sean. And a couple of questions that we have gotten throughout the month, really the past probably couple months, is around inflation. So can you talk to us a little bit about what we're monitoring in terms of inflation, what things that the Fed can do to combat that? Where is Jerome Powell? Where is he sitting? The decisions, anything like that, Sean?
Yeah, so inflation over the last 12 months has been about 5.4%. The Fed likes to try and keep it. They have an average target of 2%. So it's really gotten out of control. So the thing that we're watching is the government going to put more money in the economy? They're talking about a bipartisan infrastructure deal for $1 trillion up to 1.2 trillion. That would come into the market. Again, that's all printed cash. And so as the Fed prints more cash, we have more dollars in the system, it causes inflation. So unfortunately, I think our politicians are doing us a disservice by trying to pretend like this is just short-sighted, it's going to disappear, it's no big deal. And I think that's because it's just gotten so political, unfortunately. Right? The Fed is supposed to be apolitical, right? They're not supposed to take sides, they're not supposed to be working for any party. But unfortunately, I think that a lot of the movement has been just a little bit scared. If you add $1.2 trillion, you're going to have inflation. We've already had a massive amount of inflation, and they're talking about a potential 3.5 trillion a total package. I don't know if that will ever get through, but those are the kinds of things that we're watching to find out what's going to happen with inflation. Things that we're doing inside the portfolio, right, is we have more money allocated towards what we call TIPS, Treasury Inflation Protected Securities. So those are bonds issued by the government that match inflation. Therefore, right, as inflation grows, that portfolio grows. It's still very safe, but it is more correlated with the U.S. market than the treasuries that we just looked at. So we've got a good blend of all that in the portfolio, but we want to make sure that the bonds, the safe money in the portfolio, is keeping up with inflation, because bonds over the long term typically are earning you around 3 to 5% in that area. And so we want to make sure that if we've got bonds in there, that they're keeping up with inflation, that's going to be above that 5% number. And one of the ways we mitigate that risk by adding TIPS to the portfolio. So again, all that diversification helps us be prepared for any circumstance. If we see some pullback in the recession, the portfolio is built for that. If we see inflation move into hyperinflation, get over the double-digit mark, the portfolio is built for that, right? So that's how we're helping clients, is make sure that we're in all the right asset classes so that they can stay invested and get the returns.
Appreciate it, John. So that's kind of all the topics and questions that came in this past month. Certainly talk to your advisor, reach out to Sean and I if you have any questions. We don't necessarily recommend, just with fear and everything, moving your portfolio all into the government-backed treasury bonds or the TIPS. If you have questions, certainly reach out to Sean and I, and we'd be happy to talk about your specific situation. If you have any other questions, send them over to us, and we will be certain to address those next month when we meet in September.
Thanks, everybody. Have a great month.